Welcome to TheoTrade. This is Don Kaufman, April 17th, 2020, doing the weekend update. You know, I've now dubbed this the bad news rally. I mean, you saw Chinese GDP come out. You had more initial unemployment claims. I mean, I could go on for probably 20 minutes about some of the data that came out this week that was absolutely horrific. As I put in here a moment ago, though, yada, 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 it doesn't seem to actually make a difference at this point, but I yada, yada'd right over the best part. Does it matter what the Chinese GDP is the worst pretty much on record, or since 1992 when they started actually keeping record, that the jobless claims are just off the chart? We're at 22 million right now and counting, not to mention that many of the websites to actually file for unemployment went down this past week because of the influx. Henceforth, we call this the bad news rally. And none of it seems to matter in a Fed-backed marketplace. Let's get down to some of the price action that we saw in this week of trade. Okay, we're going to talk a little bit about the Fed, some quantitative finance. Then I'm going to get highly specific sector rotations going on, positions that I've got on, why volatility is still, quite resilient out there. We're going to cover all of it. Let's get to work here on what we call, again, the bad news rally. I'm going to start this weekend's update right here inside of the S&Ps, and I'll just detail this for a moment. What you're looking at right now, I like to kind of zoom out from time to time. This is a 30-day, 1 hour. And there is something that's I think striking, at least to me, and that is up until really just, in the last about 24 to 48 hours, we had really adhered to these gravity points. Again, the gravity points are specific kind of concentric levels. I call them concentric levels. These are levels, that are very likely heavy positioning via the trading firms that we're drawn into. We hit one of these gravity points, we literally sit on it, we reverse from it, we go higher from it. But the gravity points, we literally feel like we get pulled into them. But let me show you really like the last 24 hours of trade, because there's some action and some price action in here that it isn't so much, I should say, perplexing, but we're not adhering necessarily to some of the gravity points. And when we have seen this in the past, the marketplace goes into like fever pitch. Now, we've seen this to the upside and we've seen this to the downside, but I think it's of critical importance. And I'll actually point this out because we're crossing through gravity points like they're absolutely nothing, gapping over them. We actually adhered to a degree earlier in today's trading session. We actually opened on the 2842. We faded off of it. We adhered back to it, but then ripping through it into the cash close of today. And again, I've seen this now over just the last couple of trading sessions. Really predominantly, though, it was this last 24 hours of trade that was a bit more striking to me, that, again, we're not per se adhering to the gravity points like we were. And you can see this is just, textbook. The high was the gravity point. We actually came off, adhered to it here before breaking lower. Again, I think this is a kind of a critical, aspect. And by the way, those gravity points, if you need them, there they are on your screen. I detailed all the specific levels. Look for us to actually hit those levels and actually hold to those levels during trading days. But as I just said a moment ago, those gravity points don't necessarily hold weight when the market kind of hits a fever pitch, which has actually brought me to the point where I'm executing a couple of trades against this, thinking that maybe we've seen it, and we've seen what? Possibly even seen the end of the rally for the time being. How much more bad news can the market sustain? With that, any conversation about bad news in a rally, I think you have to bring the Fed into the conversation. So the Fed and the influence of the Fed. Let's do it. One of the first things I want to bring up to you, this is the U.S. Department of Treasury. This is actually their website. Why take a screenshot when you could just go right to the source? So if you've never actually looked at this with me, well, behold, what you're actually looking at are all the different, we have 1 month paper and 2 month and 3 month and 6 month. Hey, it's the Treasury. They'll sell any duration to you out there. You can actually go out right now for 1 month and you can make 0.12 on your money. Ooh, it's enthralling. Even if you go out to the 30-year right now, it's trading 1.27. Now, for those of you that have been around in this business for quite some time, you probably look at this and you just shake your head and go, you never thought, okay, that in the United States that you'd be seeing a 30-year at 1.27, that the 10-year is 0.65. I mean, we're only a couple of years away from what we were laughing, okay, when Japan went to negative interest rate policy, and now it isn't just possible, it's plausible that that's going to occur right here in the U.S. All right, so rates are very, very flat. And I'm going to bring this up here in just a moment. There is the possibility, okay, that the Fed goes into what they term targeted rates. That is, the Fed can actually turn around at this point. They have, okay, what they deem full control over the 10-year and full control over the 30-year. Okay, right now, they're predominantly worried, though, about the shorter term portion of the curve, keeping those rates effectively at zero. But the Fed could go into what's called targeting. And what targeting is, okay, they can say, hey, that 10-year, which right now is at 0.65, they can actually turn around and say, let's keep it between 0.6 and 0.7. Done! And what do? They buy and sell bonds based on that, and they actually target. Now, when they do targeting, they don't necessarily come out and say, let's target, because then it staves off traders completely, and the traders just basically look for 0.6, 0.7, and then basically the traders don't even want to trade, which again, I'm going to bring up here momentarily. So the other aspect is, okay, this is actually from the Fred database, and what is this? Okay, what I wanted to show you, albeit briefly here, is the acceleration, if you will, of the Fed balance sheet, because no one's ever seen anything, no one's ever heard anything like this. Okay, I'm going to start out right here. This is the beginning of 2008, and this is actually $1 trillion. Hey, what's a trillion amongst friends? So this is coming into 2008. Here's the acceleration of the balance sheet. So the Fed went from 1 trillion to 2 trillion, okay, in 08, and then kind of mellowed things out for quite some time. They got up to about 1.3 trillion. Then they slowly started to accelerate again, because back in 2011, we actually felt like we're going back into the financial crisis. So they amped it up again by about 700 billion. And then they continued to amplify the balance sheet till it got to the neighborhood of about 4.5 trillion. We started to taper it. Everybody panicked when they tapered. And then ultimately, okay, they started to actually incrementally increase the balance sheet again. And all of a sudden, here we are just a few weeks later. By the way, that's not a mistake, people. There we are. We're well north now of 6 trillion. So I just wanted to point out the magnitude of the move over here. You're sitting somewhere in the neighborhood of about 4.2 trillion. And I'll just make this very, very clear, because right in that neighborhood there it is. It's about 4.2 trillion. And right up here, right to the top of the screen, there we go, about 6.3 trillion. You've already done north of 2 trillion in the matter of a couple of weeks. And you feel free to kind of like zoom in on this one. All you have to do is Google like Fed balance sheet. It's a party, people, and apparently everybody is invited. So with the Fed on the bid right now, first thing you got to think about, and I wanted to make a couple of points. Quants rule in a Fed-backed market. You know, I keep reading all of these articles, and I really wanted to get into this on this weekend's video, and that's why I didn't do a video portion, because I wanted to spend time specifically on this. I keep getting people sending me articles, okay, from big, mutual fund managers and so forth. They go, investing is dead. Yeah, buy and hold is dead. I tend to agree with them. If the Fed is this heavily involved in the market, buy and hold, okay, classical asset management is dead. There's no reason in this business anymore to hand your money to some registered investment advisor. There's just absolutely no reason, because what the Fed is effectively telling you is we're making them what? Okay, obsolete. There's no reason to go hand your money, okay, to really anybody for longer term investment in a Fed-backed market. Okay, a couple of questions though that this actually raises, and I'm going to get to this in a second, because people look at this and they go, investing is dead. Yes, key into the terminology, people. Investing is dead. Long-term buy and hold very well may be dead. Trading, okay, this is where it's going to be at, because what you're going to learn here is that quantitative trading grips hold in a Fed-backed market. And if you want to know more about this, you can just look back at what's gone on in Japan. all right? Because their marketplace in Japan, the Bank of Japan, they've been buying up, okay? They've been buying up ETFs in Japan, still not dampening down the volatility. If you take a look over in Europe and the ECB, that's the European Central Bank, along with Mario Draghi's now retired, hiding somewhere in Italy. Nevertheless, they've been going out there and buying corporate bond market for years. Did it dampen down volatility? No, okay? But, all right, there's a key to this. First of all, if the Fed continues on the pace, are fundamentals dead? Well, absolutely, unequivocally, yeah. I mean, what does it matter when an airline, and I want to bring up some quick points over here, when an airline goes out there and they say, we want money, and how much do we want? All of it. So the airlines, and I'm going to pick on the airlines for a second. So if you don't like this conversation, that's fine. But I have to pick on the airlines for just a second, and I want to do so simply because they were given $25 billion, okay, this week. And the point being of that, what's the market cap of American Airlines? It's approximately $5 billion. Okay. If you want to, you can take a look at like United Airlines. Go look at some of the market caps out there. You can't make this stuff up. United Airlines right now has a market cap of about $7.2 billion. Okay. So you can, by the way, you can actually take a look. All right, you can go look at the number of shares outstanding, multiply it by the price, yada, yada. There's $5 billion. Basically, you could buy all the airlines, okay, all the airlines for $25 billion. How can fundamentals matter when they're actually being granted capital in here? Now, this is just going on in the airlines. Just thought the airlines were actually a marquee place to actually have that discussion. Okay, but you're going to have stocks, and you're going to have stocks even like Apple, where the Fed is going to come in and actually buy their corporate bonds, right? So if they're going to buy their corporate bonds over there, it does allow, okay, if you will, a artificially or suppressed interest rate, which is actually going to hurt. It's going to hurt, okay, someone like, well, a retail investor that wants to go out and buy corporate bonds. Well, all of those corporate bonds, the interest rates are going to go next to zero, okay, which is, again, going to have implications as to even how a company, Apple, might run. So to me, for the time being, as long as the Fed remains in the bid there, okay, and it continues to buy corporate bonds, yeah, fundamentals, okay, I believe are large part dead. You're not going to be sitting there convincing me, okay, well, look at the fundamentals of this thing over here, all right? I think the only thing you could use fundamentals for at this point is if a stock gets hammered so badly that the breakup value, okay, is worth, okay, more than what the stock is trading at, then, and only then, to the downside, could we actually use a degree of fundamentals. All right, next thing, are bonds worth looking at anymore? So one of the big questions that I've got right now, okay, bonds, and you know what, if you're not comfortable looking at the ZB, okay, which is the 30-year, bond future, or the ZN, which is the 10-year bond future, okay, bring up the TLT. One thing that's been really notable is the bonds themselves have actually been locked inside of a relatively tight range lately. We want to see if this range gets broken at all. Now, I'm actually of the opinion that the range is going to be broken. I don't necessarily think that the Fed is targeting interest rates yet. By the way, that's purely an opinion. When I'm saying I don't think, I don't know anything. But I'm actually willing to risk some capital on there, and I'm going to be looking for some trades this next week, specifically inside of the TLT. Probably something along the lines of like a ratio back spread, which maybe I've already placed. But hey, I was just nibbling a little bit earlier. Anyway, I'm going to be looking for a couple of different trades inside of the bond market because I need to know, are bonds worth looking at anymore? When I say that, again, if the Fed is just out there, let's just negate all volatility in the bond market. Oof. The distortions inside of the bond market, okay, forget about the bond market, the distortions inside the equity markets, that's why fundamentals, they are dead, because they're influencing the bonds to the degree like they're suppressing the interest rates as much as they possibly can. They're buying up corporate bonds, right? Next, got junk. I wanted to bring up a little bit about junk, specifically the HYG. Now, I felt that this story was critical because the Fed came out a little bit over a week ago, and they said now they're going to buy junk, and junk just exploded higher. And then we find out that junk is the number one new short out there. Junk is the number one new short, and you're like, wait, what? Look at this. Hard to borrow. You just can't short junk, unless, of course, you use the options market. There are traders jumping out there to want to short junk because there is a very large belief, okay, that first of all, the Fed is going out, the Fed is buying ETFs, and they're actually hired a company called BlackRock, ironically the one that actually started the HYG. They've actually hired BlackRock to do their bidding for them. Nevertheless, okay, there are a lot of traders, including myself, that don't believe that the marketplace in junk is going to be supported, okay, like you would anticipate. That the junk bonds, okay, that the Fed is buying, they're going to discriminate. And because they're going to discriminate, I still think that we could see some downside inside of junk. So I got to tell you something, okay, a short position in junk is something I am going to maintain because, again, even though the Fed is involved now in the junk marketplace, they are not going to go out there and rescue the complete and utter degenerate borrowers. I won't bring Elon Musk up at this point, but maybe a little bit later. Nevertheless, when you have the Fed, again, influencing the corporate bond market, it does allow just that degenerate borrowing kind of through and through. All right, so I made a big statement a moment ago. I talked about quants rule in a Fed-backed market. And that's why I was bringing up the bonds a little bit, okay? When I say quants rule in a Fed-backed market, at this point, it becomes sector rotations, okay? So when you think about, classical investing, this stock is going to go up and this stock is going to go down, okay? It's more about rotations. And that's precisely what we're seeing day in and day out. It's tech, it's financials, it's energy, it's consumer staples. Gold. You're like, gold is not a sector, Don, it's a commodity. Yes, I am very aware, okay? But gold, the volatility in there, it's all over the place lately, so I wanted to throw it into the mix, which I'll come to in a moment. But when I say sector rotations, I have been picking on, okay, incessantly technology lately. Okay, and I wanted to show you this because the S&Ps today had a wicked little rally, right? The S&Ps are up 3%. Did you know that the monsters of tech, now what are the monsters of tech? That's the collective of Facebook and Apple and Microsoft and Google and Amazon. The monsters of tech, massively unchanged on the trading day. This is exactly what I'm talking about. People, this is a sector rotation. We've been seeing it throughout the course of the week, and we are on it right now. And when I say on it, this has actually been a great degree of profitability this past week of trade. We've actually rotated out, okay, of the financials earlier in the week, and now we're rotating back into the financials. Then we're rotating out of tech. Meanwhile, we'll bring up the energy sector, which 10%. But were you aware that they rotated out, okay, of the energy sector? So the rotations, the way they seem to be working right now, okay, financials are tied, okay, with the energy sector right now. These, you start looking at it in financials and energy. Let's just talk about financials and energy. Both have just been decimated lately. Let me bring up the chart on there. Okay, when you start to look at financials, and I'll pull this up on a year-to-date basis. Okay, they're down about 30%, and then you start to look at the energy sector, and it's down about 43%. All right, so they've both been decimated. But then you flip it over, and you start looking at the monsters of tech. The monsters of tech, they're actually up 4% year-to-date basis. Year-to-date basis, the monsters of tech are up 4%. Again, that's a conglomerate symbol, though, that we built. So, again, day in and day out, you're seeing this kind of wild rotation. I just want to show you this week of trade where you've actually got, some huge move up in the monsters of tech and then completely and utterly flat. Meanwhile, if you take a look at this in terms of sector rotation, they were rotating out of financials, and then all of a sudden, boom, bid back into it. The exact same thing is true, okay, of the energy sector. So we've got sector rotations. You can get on these, and you can start to hop on these, and you can start to trade like XLE versus the QQQ, or XLE versus, okay, even individual stocks like ExxonMobil against Apple, and you're like, oh, that's crazy. Are we really getting into pairs trading? Possibly. But if you're not comfortable down that road, okay, well, this can actually just be traded on an intraday basis. You can wake up and be like, hey, tech's really strong. I guess I should short financials. Or financials are really strong. Maybe I should turn around and short tech. And it's been like this now for the remainder of the week. Now, playing into this also happens to be none other than consumer staples. You're like, wait, what? Well, as I said a moment ago, if you looked at energy, okay, energy is actually almost like tied at the hip with the XLF. Well, interestingly enough, when you start looking at stuff like Apple and some of the tech stocks, okay, they're actually moving kind of in cahoots, if you will, with some of the consumer staple stocks. Right? So again, we're seeing some really interesting rotations. By the way, these rotations, I don't expect people to pick this up like, immediately. This took me years years to actually figure out sector rotations. And this is what quantitative finance is about. Now, I look at a lot more, by the way. I don't pull this stuff up on charts on a day-to-day basis. I am actually looking, if you will, at correlation coefficients between these products. All right, I'm actually a much more, again, quantitative or mathematically inclined individual. I actually look at the standard deviation of one versus the other. There's a bunch of studies. I'll cover those live in the TheoTrade chat room throughout the course of this next week. Now, I wanted to throw a little bit of a curveball at you. I also wanted to throw gold in here. Okay, so as I start to bring up GLD, gold. It's gold, Jerry, gold. Gold's commodity. All right, but at the exact same time, the influence of gold, okay, versus what the Fed is doing versus what the S&Ps, it's interesting to see that gold is now back on the bid because you can't make too many arguments. The dollar is having an influence. The dollar, not so much. Okay, why is gold running right now to the upside? It's a great question. And at the exact same time, I actually took advantage of this and I put on a ratio back spread to the downside with a little bit of an in-out spread to the upside. So I'm actually trading literally on both sides of this. If you look at the analysis of this particular trade, the analysis, right here, I'm right to the point where the ratio back spread could really pick up some steam. It's, again, a little bit of an out there trade, but in some of the commodity products, this is the way you want to start to think. The commodity products are going to see extraordinary volatility. Why? Because the bond market right now, every bond trader that I know, and I know a lot of them, they're nervous, okay? They're actually backing off a little bit. So without the bonds to trade, a lot of these traders are actually moving towards commodity markets, okay? And the volatility has really picked up in here. And in most cases, the actual price movement in gold is far exceeding. Like if you take a look at what's called expected moves, okay? The expected moves, look at this. Okay, oh, tried for the corner and missed. This one's outside the expected move. This one's outside. I mean, it's day in, day out. Wild, wild moves inside some of the commodity markets. And again, I believe that this is probably pressure, if you will, from the Fed in the last couple of weeks that they've been on the bid. The next thing I want to bring up over here is why is volatility so high? Okay, bottom line, I got more questions than answers. Volatility remains extraordinarily high even with this rally. The volatility, you're like, oh, it's really backing off. No, it's really not backing off. Okay, say what you will, it's at a 50% retracement. Listen, volatility before this entire event occurred was down at 14. Volatility now is at 38. And volatility, forget about charting and technicals, forget all that garbage on there. Okay, it's not linear. Like you don't look at volatility. A VIX at 40, okay, a VIX at 40 is some serious crap. Right? It's what? You look at like a VIX at 14, it's nothing, lad. But a VIX at 40, that's a world that's rocking out there. And we're rocking, but to the upside. So the bottom line with this, with volatility so high, and again, I prefer to look at the VVIX. With volatility so high, you can't trust necessarily when I say you can't trust what you see on the screen. It doesn't matter whether we're rallying or selling off over here. With high volatility, okay, it's complete and utter free-for-all. And you can't forget that. You can't forget that with your allocations in a marketplace, all right, like this. And I got to say, it's a bad news rally, but volatility remains high. Why does it remain high? Because it's screaming to you, okay? And it really is screaming to you. I'm dangerous, okay? I'm very dangerous, and you better remember that. All right, expected move. Not a ton on this one this week. I'm going to make this short. I'm going to make it sweet. We ended up inside the expected move. So here we are, 11 out of the last 14 weeks. 11 out of the last 14 weeks, we cracked outside the expected move. So this week, we end up inside the expected move. So for those of you like, this has been a blistering rally, I'll show you where the rally really occurred. If you take a look at the QQQ auto expected moves, the Qs smoked the upside of the expected move. Okay, take a look at the IWM. The IWM ended up what 4.25% here. But here's the interesting irony. The irony is that the IWM was actually down on the week. So everybody's like, this has been a blistering rally. Well, yeah, but if you're in the IWM, okay, they pulled that thing together. If you're in the QQQ, this thing exploded to the upside. Do you see what I'm talking about with sector rotations now? Do you get it? Okay, you should, because I'll tell you right now, I just put a short position on specifically in the QQQ because we're so far outside the expected move. Okay, I would fully anticipate that the IWM and the QQQ will converge a bit more this week. That's why I wanted to cover that. So with the SPX and its expected move, I'll knock that out for a second. With the SPX and the expected move this next week, and again, where do I derive the SPX expected move from? Just go 7 days out. Go 7 days out over here. Take a quick glance. It's about 111 and change. Okay, so I had 111, and we can actually put it really specific now. 111, we'll call it 89, all right? 111.89, that's the expected move for the week, and I'll actually draw that on the chart. So what do we expect? Are we going to be inside that? I don't think so. I just don't think so. I don't care that we just ended up inside the expected move. I'm going with the odds. Come on. 11 out of the last 14 weeks, we've cracked through the expected moves. Let's see some more. Last but not least, stock chop. Microsoft, Lulu, XLP. What do they have in common? I'm short all three. I'm not short the outright stock, but I did want to actually bring up once again some short positions. Microsoft, okay, I'm short. I'm short in this neighborhood down here, and I'm taking some pain in the last couple of days. But I'm going to tell you right now, that's what it takes, okay, in this business. And this is a duration position. I am not short the outright stock. I am actually using a deep in the money put. Lululemon, okay, Lululemon. I've talked about Microsoft incessantly. Lululemon, okay. I'm re-upping a short position. This one is a critical, and again, listen very carefully. I am re-upping a short position. I was short Lulu the entire way down, covered in this neighborhood here. Now we've bid back through the roof. I mean, yoga pants, people, yoga pants. Forget for a second that they're down only 3%, okay, and they're closed. Forget that for a second. Oh, there's e-commerce. Oh, I'm so sorry. They're up 32% year over year. That's a 1 year on a percentage basis. They're up 32%. I'm sorry, okay, but in the midst of the bad news rally, I want to be short inside of Lulu. Last but not least in here, XLP. What is XLP? Okay, and again, I've talked about this pretty much ad nauseum as well. When you look at the XLP, okay, and again, this is year over year, it's up 6.4%. Sooner or later, we're going to realize, okay, that our castles built of toilet paper are not necessarily, needed, and you're actually going to see some of this start to taper off. And I believe that is going to have a very negative impact on the sector itself. So look for it when some of the panic kind of fades out, when we're not rushing to the store and buying hundreds of dollars of paper towels anymore, loaded up on meat in multiple freezers. Come on. Anyway, when we've battened down the hatches, these things went absolutely crazy. They got a bid back under them. I expect the next bout of volatility, though, that the XLP is going to get hit just as hard as the rest of the marketplace. Listen, huge amount to think about in this weekend's update. It is the bad news rally. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.